Hi everyone, my name is Piterpakulski. Today we will continue building financial model for a manufacturing business idea, and today I will be showing you some other interesting ratios that you may need when you will be modeling your project. Today we will be talking about profitability, about different ratios inside profitability. It doesn't matter how we are gonna call these ratios. I will be just talking about the essence of these ratios and why you really need these ratios to analyze your business idea. So maybe this video will be useful for you. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will keep all these tutorials, and when I finish this financial model I will place all the links how I created this financial model from scratch in the description of this video as well, so you can watch all the tutorials for free from scratch till the end. So let me just first of all let me run through what I already did. Let's have a short overview. So these cells, blue cells, are inputs. So we have a unique rule throughout through the whole financial model. So blue color is the color of inputs, so we can easily find the inputs and play with it. So we have two products, product A and product B. We can switch these products from calculations. We have two manufacturing lines. We can switch on and off each product line from calculation. Then we can allocate the time when we produce product A and product B on line 1 and line 2. Then we specify when we start operating activity. Then we created the block of inputs where we were modeling how fast we are reaching the target revenues from the moment when we start operating activity. Then we were modeling the shifts, so we assumed that we have for two lines, for each of them we have 3 shifts. We can switch them on and off and set up when each shift appears. Then we specified how many hours do we have in one shift, and then we moved to the block of inputs where we touched the amount of work days inside the typical year. Then we started modeling the library for raw materials which participate in manufacturing process. Then we started modeling what raw materials participate in product A manufacturing process, product B manufacturing process. We moved to investment and we described when and what we invest in during the investment stage before operating activity starts. Then we started describing the payroll which is linked to line 1, line 2, depending on how many shifts this line works. Then we worked on payroll which was stable. Then we moved to the payroll which is linked to the amount of units of product A and product B produced. Then we started moving to the revenues. We assumed that we have 3 types of customers for each product. And each of those types of customers may have different pricing, So they have, so we are selling them with different prices, so they are paying us, they pay us with different payment algorithms, so we can play with all this stuff. Then we moved to other direct costs like electricity, or direct costs that are linked to the amount of raw materials needed in manufacturing process, or direct costs that are linked to the amount of shifts that line 1 and line 2 work monthly. And then we moved to packaging costs like pallets. Then we were focused on fixed expenses. We took the typical year and described what kind of fixed cost items we have. Then we moved to loan modeling. Then we created the cash flow statement, calculated the amount of financing needed. Then we calculated payback period, created a simple table for profit and profitability. Then we calculated discounted cash flow, and as a result we were able to get net present value. So we already calculated simple discounted payback period, net value, net present value, and today now we will be modeling some interesting ratios, profitability ratios. Let's create a table. Let's name it types of profitability. So the first type of profitability will be, let's say, variable cost profitability. Variable cost profitability. So what I will do, I will go to the cash flow statement, and we have revenues and direct costs. I will take revenues minus direct costs, and the result of this exercise I will divide by the revenues. If error, I will put here a 0. The next profitability will be operating activity profitability. The formula for that will be, I will take operating activity and the result from operating activity and divide it by the revenues. So this means that revenues minus direct costs minus payroll minus fixed costs minus taxes, this is the result from operating activity, and this value we divide by revenue. So if error, we will put here 0. this is the second type of profitability that we need, and the third one will be business, let's say business profitability. So this will be the result from operating activity minus principal payments minus interest payments, then all that stuff I will divide by the revenues. If error, I will put here 0, closing brackets, pressing enter. I will take the percentage format here, extrapolating this formula to the right. So now we are done with these ratios, the types of profitability, and now let's talk what do these numbers mean, because they are extremely interesting. So the first story, for example, if let's look for example at February 24, this means, for example, let's go up. If this type of profitability, for example, is already, let's say, 5%, 7%, so it is low. This means that you have a very small gap of adjusting the business parameters if something goes wrong with your business idea, if something goes wrong during the operating activity. Because direct costs mainly define your product or a service that you provide. And if you start working with your variable costs, you may get another product or another service. And if this profitability is already low, you can't be playing with your direct expenses the way you want, because if you will be trying to use some other raw materials, the product or your service may get another properties, and this will be another product or another service, and this will be another market for your product or your service. This will change changing the variables, adjusting variables may affect the quality of your product. So this means that if this ratio is already low, this means that you can't be playing with your variables at all. So you have nothing to do if for example, if other costs will grow, you have no gap of playing with business parameters, and that's a risky situation because you have no place for maneuver if something goes wrong, because in most cases you can't be playing with variable costs. And this is very important because variable costs, they define the quality of your service or your product, and they are very important. So if you started playing with variable costs, you may get another product, another service, and you will need to focus this product or service on another market, and this will be another business concept, another story. So, and this is very important. So if this profitability value is, for example, 5-7%, they have very thin margin to play with, and that's a risky scenario. So this is the first story. Then if we talk about operating activity profitability, so if, for example, this value is For example, let's go. So if, for example, so what does this mean? For example, let's look at December 24. If this number drops just a little bit from this number to this number, and the difference is very small, is tiny, this means that you have a small amount of overhead expenses, and that's okay. But if this profitability drops significantly to this number, so for example, if you have here 38%, and then suddenly you have, for example, 10% here profitability instead of 30, this means that you have a huge amount of non-productive costs, such as, for example, office expenses, maybe rent, people hired that you don't need, and you have to look at your, for example, let's go up. So this profit, if you divide this by this and this type of profitability is already low, and this drops significantly from this level to this level. So for example, you have 38 here and 10, for example, here. This means that you have to at your payroll expenses, fixed costs, taxes that you pay. So you have to look at all these types of expenses, and you have to go expense article one by one, and think what you can, what types of costs you can decrease. And this is a huge field of cost optimization in this way, and it is vital when you see that this profitability drops significantly from this level to this level. This means that you have to look very attentively to all fixed costs, all payroll, all taxes, and think how you can try to decrease all these costs, because there is a field for decreasing these costs. These costs are not variables. They not mainly define the property and the quality of your business idea, of your product or service. So you have more opportunities to work with all these costs. You can, for example, find a new office or a new warehouse, so you can hire, for example, less people, and so on. So there are some ways of cost optimization in this way. Then if we look at how if the level of profitability significantly drops from this value to this value, so for example, for example here, so here it is positive, and then negative. This means that the loan significantly affects your business idea, eating all the profits that you gained inside operating activity. If we go up, for example, we will be able to see that here we have operating a profit, and then we need to pay to the bank, and bank will eat all our operating profit, plus we need to save some additional cash from previous profits to pay these payments. So this means that you have to, if this value is significantly lower than this value, this means that you have to think about the way you finance your business idea. So maybe you have to wait a little bit, or to find a partner or business partner, or you need to save some time and to add more equity from your pocket. This will avoid you from these payments to the bank. And if you start adjusting, if you start increasing your own equity, your own money in the project, and start reducing the amount of the loan you will need, so you will see how, for example, these numbers may change to this. So this is, here it is negative, but for example here it is also positive, but you can see that still this number is twice bigger than this number. This means that half of what we earned we paid to the bank. So we can see here, so we earned 12, but we paid to the bank $6 million. So that's why when you start looking at these numbers for profitability, you will first of all look at your business idea, business concept. You will look at your product. You will maybe you will rethink the properties of your product or service. You will look at the way you're gonna finance your business idea. So you will get a huge piece of information that will be very useful for you. And that's why I decided to show you these 3 different types of profitability. It doesn't matter how we call it, but the essence, I just want to share you the essence of these three parameters. I hope this will help you when you start creating your own business. So you may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. At the end screen of this video I will give you the link to the playlist where I will be keeping all these tutorials. And when I will be done with this model, I will put all the links on these tutorials from scratch in the description of this video as well, so you may watch all these tutorials for free. So thank you guys for watching. See you next videos. Thank you and bye.